What's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast, and welcome to another Whiteboard Fireside Chat. Last week, we were in Jacksonville, Florida, meeting with some of our clients locally there. It is our review season, as many of you already know, and it is heavy on tax planning this time of year. And one of the scenarios that we run into oftentimes, and a scenario we ran into twice last week, was this concept of a surviving spouse tax penalty. Okay, now it's difficult enough to lose a spouse, but one of the things that I oftentimes hear is they were very surprised, surviving spouses are very surprised at how much more taxes that they're paying now relative to what they were paying when they were filing jointly, when they were married. Okay, so for those of you that don't know, when you're filing joint, if you are married and your spouse passes away, that year you can continue to file joint. Okay, so if your spouse passed away in 2024, you can still file as a married joint filer for this tax year. But next year, you're likely going to have to switch over to a single filer, unless you have a qualifying dependent, whether it's a parent on your tax return, or maybe it's an adult child, or maybe it's a minor child that you're still caring for, and they're still dependent on your tax return. You could potentially qualify for a qualifying widower tax filing status, which is more favorable. It's essentially the married filing joint status for the next couple of years. But ultimately, you're going to have to switch over to a single filing status at some point in time. And really, the way the brackets are designed, which we're going to look at in just a second, they're designed to essentially, get cut in half. Okay, so they're assuming that a married couple, their taxable income is going to be 2x that of a single filer, which could be true while you're working, but when you're retired, income stays pretty similar. Certainly Social Security is going to go down, but things like interest income or dividends from stocks you own or capital gain distributions or distributions from IRAs, whether it's required minimum distributions or simply taxable distributions, are likely going to stay pretty much the same. Okay, there might be a little bit of a drop off, but my experience, it's not 50% reduction. Okay, so we're going to look at the impact here. We'll just briefly look at the tax brackets. We're going to look at a couple of different scenarios for a married filing joint couple versus a single individual in my practice, looking at their actual taxable income. And then we'll also look at some of the other impacts, like things like Medicare surcharges or IRMAA surcharges. And then we're going to finish off talking about some of the planning opportunities that we see clients implement, not just for preparing for a surviving spouse tax penalty, but more so to optimize their tax efficiency of distributions throughout retirement. And so without further ado, why don't we jump into the whiteboard here? So why don't we just start looking at the tax brackets? This is for 2023, and I'm gonna ignore this right side, this head of household. Most of you are going to be married, filing jointly, or single. And like I mentioned, the tax brackets are really designed to 2x from single to married, filing jointly. And that is true up until the 35% bracket. So anything 32 and above, you'll notice that, if you look at the 10% bracket, it's 0 to 11,000 for single, but then if married filing jointly, it's 0 to 22,000. And then 12%, 11 to 44, and then you've got 22 to 89 and some change for married filing jointly. So in general, you see the brackets 2x up until this 35% bracket, and then it tapers off a little bit, particularly for that upper range. And then the same is true for that 37% bracket. But one thing I'll point out here is this is for taxable income. Okay, this is not for gross income. So this is after deductions. And one of the important things to note is that the standard deduction is higher for married filing joint versus a single filer. Okay, I'll give you an example. This particular client that I'm looking at their tax return, married filing jointly, their standard deduction for 2023 was $30,700. Okay, so their standard deduction was $30,700. They are over 65. That's why you get a little bit of an additional deduction for that. But if you're single, same thing for 2023. This particular client's tax return I'm looking at, her standard deduction was around 15,700. Was 15,700. So right off the bat, you see the impact. Not only does income not go down by 50%, but your standard deduction does, okay? And so this does impact your taxable income. And I'm looking at this particular client's tax return. I already know she's paying significantly more in taxes than a married filing joint couple with a very similar taxable income. But, if you have a client, let's say they're kind of fringe on this 22% bracket. Let's say they're sitting comfortably here after deductions, at around, let's say, 83K. And then let's say, if something were to happen to one of the spouses, now the surviving spouse maybe gets less in Social Security, and maybe the distributions go down a little bit, capital gain distributions, et cetera, but not by 50%. But let's say their income goes down to $60,000. Okay, over here, look at this. When you were sitting in that 12% bracket when you were filing jointly, now you're sitting over here, right here, if your taxable income is 60K. Okay, so it's really these fringe, these clients, these couples that are on the fringe, whether it's on the fringe of moving up or moving down, that can really provide, make a significant impact on the taxes that surviving spouse is going to pay. I'm going to look at an actual return from a client. So we've got, for 2023, two examples here. We've got a married filing joint couple here. Let's start with that one. They have a total income, gross income of 114K. All right, so that's before deductions. It's 114 and some change. But they do have the standard deduction. Okay, so minus 30,700. Most of you are taking the standard deduction. Since the Tax Cuts and Jobs Act was put into law in 2018, I think the stat is about 91% of taxpayers simply take the standard deduction. Okay, and so what that means is regardless of what your itemized deductions are, medical costs, charitable donations, mortgage interest, student loan payments, whatever those are, regardless of what those total up to, if it's less than 30,700, like for this particular couple, again, this is a married filing joint couple in 2023 that's also over the age of 65. If your itemized deductions don't exceed the standard deduction, the itemized deductions don't really do anything for you, okay? You're simply just going to take the standard deduction. And that was really what I think Trump was trying to do. He was trying to simplify the tax code and just say, forget about all these unnecessary deductions, just take the standard. And for 91% of the population, that is true. For the other 9%, you are still itemizing. But a lot of you are going to be taking that standard deduction, especially as you approach retirement and get into retirement. Maybe you've paid off your mortgage. Certainly you might have some medical bills, but maybe it's pretty nominal in that early phase of retirement during your go-go years until they start to potentially ramp up later on. But this particular couple, their taxable income after those deductions is going to be somewhere in the neighborhood of about $83,270. Okay. And if we look back, 83,270, they're firmly planted in that 12% bracket. Okay. Well, what you don't know is some of that is Social Security income, and not all of that Social Security income is actually going to be taxable. Okay, so the impact of this particular couple, if one were to pass away, I'm going to flip them over to the single filer, is very similar to the single filing tax return that I'm looking at, where Social Security income, or the taxable portion of the Social Security income, went down by about roughly $12,000, but everything else stayed the same. Okay. RMDs continued as is because both of them were RMDAs. They're both taking minimum distribution, so those are going to continue as is. Everything that's invested in their brokerage account is going to continue as is. They're not going to change over all of their investments or do a fire sale on their investments. So in general, they're going to have very similar capital gain distributions. But in this case, their gross income is going to start out about 102 because of that reduction in Social Security. And then the standard deduction is lower. The standard deduction for this individual, a single individual, is $15,700. All right, so now you have the taxable income in the amount of $87,115. All right, let's compare that. Where are they at with $87,000 of income? Right here, $87,000 of income. They're now in that 22% bracket. And I'm not going to show you their tax return, but I'm just going to tell you, in terms of total taxes paid, we're looking at the married filing joint couple paying about $91.33 in tax. So their total tax was $91.33, whereas the total tax for the single filer, $14,226. Again, this is for 2023. So you're looking at about a $5,100 approximate increase in their taxes paid in that year of 2023, assuming this scenario played out. Now, obviously, everyone's scenario is going to be different. Maybe Social Security drops by a little bit more. Maybe some of that income is pension income, and maybe the pension income goes away completely, or maybe that gets reduced by 50%. Okay, but I think the point is, taxable income doesn't necessarily go down by 50%, but the tax brackets do, and so does that standard deduction. So that could oftentimes lead to this significant increase in taxes paid, in this case, about $5,000. Another thing to think about is IRMA, income related monthly adjustment amount. Okay, so the surcharge 2023 taxes impact what you're going to pay for 2025. So the first threshold for IRMA, if you're married filing jointly, is if your income is less than 212K, you're not going to have any surcharge. Whereas a single, it's got to be lower than 106K. All right. And so for this individual, because this calculation here, this IRMA calculation, is based on your modified adjusted gross income. And we did a whiteboard fireside chat on that recently. So go back and look at that video. It's something along the lines of, will I pay IRMA taxes in 2025? So I break down how that calculation for modified adjusted gross income works. But it's not taxable income. It's modified adjusted gross income. And I looked at their tax returns for 2023. The married filing joint couple, their MAGI, okay, was about 114, whereas the MAGI for the single filer, that scenario that I just broke down, was 107K. So despite the fact that income, yes, went down a little bit, you make some adjustments on there with the municipal bond interest income and some of the some of those other add backs, and now we've got, all of a sudden, now we're also paying surcharges in the amount of about $1,000 a year. It's not a huge penalty in that first little band, that first premium band. Once you get to the next premium band, or that next band of income, then it does start to go up a little bit. Okay. But in general, you look at that $5,000 of additional tax, and you look at about $1,000 in additional Medicare surcharges. All of a sudden, the surviving spouse is paying a little bit more than $6,000 a year of additional taxes that they otherwise weren't paying when they were filing jointly. So just food for thought that this is a real thing. Okay, this surviving spouse used to be called the widower's penalty. It is a real thing. But what I tell people is, don't necessarily just plan all of your tax planning opportunities just based on this fact. But if it moves the needle for you as a couple, okay, whether it's Roth conversions or tax loss harvest, if it's going to move the needle for you as a couple, then you might want to also consider it if one of you is expected to outlive the other substantially. Maybe one of you has an illness or a diagnosis that is going to, it's going to be very, very likely that your spouse is going to outlive you substantially. You might consider this a little bit more. You might weigh this a little bit more heavily. All right. So what are some of those opportunities? Okay. So, the obvious ones are on the conversion piece. Okay. So if you've got, actually, why don't we start with contributions? Okay. Maybe you're still working. Maybe you're in your 50s, right? Or early 60s. You're still working. And, maybe your taxable income is kind of borderline. Maybe you're sort of teetering on that 24, 22% bracket. Or maybe you're firmly planted in the 22% bracket, and you kind of might see a little bit of a drop off early in retirement, which could provide some Roth conversion opportunities. But long term, you see your tax bracket being probably in that 22% range, for the foreseeable future. Maybe you really think through, Roth contributions. Okay. So instead of doing pre-tax, which many of you might do, especially if you're in your peak earning years, maybe you think through these Roth contributions in lieu of traditional contributions, because that's ultimately going to allow you to have those dollars go in tax-free, and those accounts do not require minimum distributions on the back end, and any distributions that do happen during retirement, assuming they are qualified, will be considered tax-free. So this is a way for you to keep that taxable income down for your surviving spouse if you were to predecease them. Okay. Of course, we've got Roth conversions. All right. So Roth conversions. So this is when you take dollars from your pre-tax account, you go ahead and move them over to your Roth account. You go ahead and pay the taxes on that conversion on whatever your tax bracket or your effective tax bracket is. But now you have these dollars growing in this tax-free bucket. So this is great for those of you who are early in retirement. You haven't started RMDs. Maybe you haven't started Social Security yet. You might be considering Roth conversions. And there's other reasons for Roth conversions. There's other reasons to pursue Roth conversions. It's about minimizing your lifetime taxes paid. It's about, maximizing the tax adjusted ending capital for your beneficiaries. Okay. But it could also be to minimize the impact of the surviving spouse tax penalty. It could also be to minimize IRMA surcharges. Okay. But these conversions could also help your partner, your spouse, if you were to predecease them, because again, those distributions of the back end are not taxable and they are not subject to those required minimum distributions that tax deferred accounts have. Another opportunity I'll put in here is, asset location. Okay, so if you invest in taxable brokerage accounts, which many of you PFR Nation, you're probably going to have the taxable brokerage account. So you're maxing out the traditional 401ks, you're maxing out the backdoor Roth, you're maxing out the mega after tax. Maybe you're maxing out the HSA and you still have room to save more. You might consider pumping money into a taxable brokerage account. Just be careful with how efficient those investments are from a tax perspective, or how inefficient they are. Okay. So if you own investments in that taxable brokerage account that are actively managed and they're spinning off a ton of capital gains on a year-to-year basis, that's going to create taxable income. If you invest in a ton of bonds, whether it's municipal bonds or taxable bonds, that's also going to generate interest income that's counted for certain things like income-related monthly adjustment amounts for the MAGI calculation, or just simply included in your taxable income in general. Okay. Whereas stocks, the dividends they pay, they do create capital gains on if they're qualified dividends. If they're non-qualified, it will be treated as regular income, but that could also add additional taxes to your tax return as well. Okay, now dividends are more favorable, no question, but you want to really make sure you're sort of minimizing the tax impact of investments you make inside of those taxable brokerage accounts. So I tell people, own the tax inefficient investments inside of your IRAs or Roth accounts, and own the tax efficient investments inside of that taxable brokerage account. Okay. Now, to combat that, you could also consider tax loss harvesting. Try to write a little neater here for you guys. So tax loss harvesting simply involves selling something that is at a loss, a paper loss, and creating a realized loss. Now you can use those realized losses to offset capital gains, whether it's capital gain distributions or distributions from you selling an investment at a gain. Okay, now the key is you need to have an investment at a loss, all right? And over the last couple of years, the market's been, pretty steady in the upward direction. But anytime there's periods of volatility, you want to take advantage of some tax loss harvesting opportunities, because then you can sort of lock in those losses for those future gains, or you can use up to $3,000 per year to deduct against your ordinary income. Okay, if you have unused losses that you're not going to offset any gains with, you can carry forward those losses, and then you can use up to $3,000 on an annual basis to reduce ordinary income. And then the last thing I'll throw in here is charitable donations, charitable contributions. All right, so maybe it's donor advised funds, maybe it's qualified charitable distributions. But the key is unlocking some tax deductions or essentially tax-free gifts that you otherwise might not have been taking advantage of in order to keep that income down. All right. And this ultimately could benefit not only you as a couple, but also your surviving spouse going forward. Okay. And so there could be a year where maybe you're doing some Roth conversions and, you really want to combat that surviving spouse tax penalty. Maybe you sort of counter those Roth conversions with doing donor advice, in the beginning, so you can really maximize your deductions while you're doing those conversions. And that way in the back end, now you have a very small traditional IRA or traditional 401k and a very large tax-free bucket. And now you can sort of taper off those donor advised fund contributions. And now you can just donate to charity directly out of that donor advised fund. If you're over the age of 70 and a half, you can donate in 2024 up to $105,000 directly from your IRA. And better yet, if you're taking required minimum distributions, you can donate up to $105,000 from your IRA if it's donated directly to a qualified 501c3 organization. Okay, and I say donate directly to a qualified 501c3 because it has to be a real charity. It can't be, little Johnny's, college fund. It's got to be a real charity that you're donating to, and then making sure you're tracking that properly. Okay, so when you're filing your taxes, and if you're doing a QCD, give that information to your tax preparer, because ultimately the tax preparer or the brokerage firm your custody with, whether it's Schwab or Fidelity or Vanguard, they're simply just going to send you a 1099 saying, hey, you took a distribution of X. Let's say it was 50,000, but let's say of that 50,000, 10,000 went directly to charity via the QCD. You save that receipt, you save that charitable donation receipt, obviously you need to have done it right, correctly. You needed to fill out the QCD form with your custodian, and then the custodian sends that $10,000 directly to the charity. But if you did it right, you can now exclude that $10,000 from your taxable income. So it's in effect more efficient than a tax deduction, because it doesn't matter if you're itemizing or taking the standard deduction. So QCD is super powerful. So all of a sudden, if you inherit this IRA, and now you're taking RMDs from your spouse's IRA, and you're also supposed to take RMDs on your own IRA, and all of a sudden you're like, I don't need all of this income for tax purposes. Maybe I do donate. Maybe I switch my charitable donations over to QCDs versus just donating securities, donating cash, or even donating into your donor advised fund. So these are some of the opportunities to really look at. And, frankly, this is just good tax planning in general. This isn't just for, hey, I'm married, or, I'm planning to, for my spouse to outlive me, or I'm planning to outlive my spouse for 10 plus years. And so I'm going to be doing all these things. No, you want to first do this because it makes sense for your financial plan. And then ultimately you want to understand how the surviving tax penalty could potentially impact you or a spouse, and just know how this thing works. And then if you feel like this is something that can move the needle, you just want to weigh on this a little bit more heavily than you otherwise would have. Okay. So hopefully you found this helpful. If you found it helpful, just make sure to subscribe to the channel. We appreciate that. That supports our show. It allows us to reach more people, trick the algorithm, so we're able to make an impact on more people, which is what we're all about. And of course, make sure to check out the podcast every other Thursday. The one I'm actually putting out next week on Thanksgiving Day is going to be about tax planning opportunities before the year ends. So you're not going to want to miss that one. It should be really, really useful as we prepare to finish out the year. But until next time, everybody, appreciate all of you. This is Kevin Lau signing off.